Hello and welcome to BQ Prime. Figures for inflation and industrial output were published just a short while back, both surprised on the upside. While industrial output came in at 10.3% for August, the highest in 14 months, inflation eased to a 3-month low at 5.02%. Now, to join us and give us a little bit more information on these figures today, we have Indranil Pan, Chief Economist at Yes Bank, and Radhika Rao, Senior Vice President and Economist at DBS Bank. Thank you very much to both of you for taking time out for us today.
Thank you.
So, Indranil, I would like to start with you. What's your quick takeaway from both of these figures? Both appear to have surprised on the upside.
Definitely, I would be talking about the inflation number first. 5.02 was not in the forecast horizon for any of the economists that I would have spoken to. We were ourselves at the median level of around, say, 5.3%. I think the biggest surprise for us, if you want to ask, is the vegetable prices. Yes, we were looking at a drop in the vegetable prices. The NHP data did show a drop of about 19 to 20% in the vegetable prices. And a significant portion of that seems to have been factored in. The other positive aspect is also the core inflation, which is down to a 4.5%. And ex-pan and tobacco, the core is down to a 4.6%, with a drop in the housing prices as well as the clothing and footwear prices. I think the services sector prices have not really altered too significantly. So either you look at it from the vegetable side and the food basket as a whole, or the core side, we have a comfort, except for the fact that we need to, from now on, watch on in terms of the pulses prices, which seems to have surprised on the higher side.
Sure. Radhika, what's the surprise element here then? The figure does seem to be better than was being expected.
Hi, thank you so much. So certainly, I think just like you mentioned, we had also expected a correction, a fall in vegetables inflation month on month. That has panned out, but is slightly bigger in magnitude than we would have anticipated. So I think that's where the big difference has come from. Because if you see the non-food part, there it is pretty much steady. For example, steady in the especially services. But if you see fuel, base effects are quite significant. For example, same time last year, we were running at about 10.8% kind of rise in the fuel and light segment. This month, we have seen a negative reading for the year-on-year number. So I think the biggest surprise, 2 months back, the biggest upside surprise was on account of food. And I think today, the biggest downside surprise has been on the food front, particularly perishables. And I think it certainly does help. First of all, food being looking good on the headline level. And at the same time, if you talk about high oil prices outside, I think the expectations are that it won't get passed on to the retail pump prices, which means food and fuel, which typically tends to impact inflationary expectations, that are not that much as a risk at this point. But of course, if you want to get granular, you would see that amongst the food segments itself, there are few components, especially food cereals as well as food pulses and products. So if you add these two, the weight is actually higher than vegetables. That has been gradually but consistently been rising. So I think while food tends to be very volatile, these components, while they rise, over a few months. They don't correct as fast. So I think that's where the official focus would be, I would think. And of course, we've also heard some speculation that sugar could be next, where some restrictions could be introduced. So if you want to get granular, I think there are some pockets of concern, but overall at the headline level, certainly positive reading as far as anchoring inflationary expectations go.
All right. So, Radhika, like you've mentioned, pulses and cereals saw elevated inflation, while cereal prices rose 10.95%. Pulses inflation was at 16.4%. Also, like you just said, that these are figures which don't quickly change. These tend to be a little bit more sticky then maybe vegetables. So what's the outlook going forward, given what monsoons this time was, and given some of the risks that even the RBI outlined in the last MPC?
So I think if we were to hear the official commentary, especially from administrative measures and from the government, I think their focus has been very clear. Uh, I think it's just not India. If you see even outside India, in fact, rice as well as some other pockets have been quite persistently rising. So I think while it be difficult to reverse course the way vegetables have done, when 2 months back 30% to now 3% rise, so that's been pretty big a change. In cereals, I think what the hopes are that it would be slower in its rise, that we can aim for that. And I think that's why we have seen talks of pulses imports possibly. Of course, there is not much of excess stock outside, but nonetheless, from markets like Australia, from markets like Myanmar, we could see higher exports. Even internally, if there is, we'll try to put new stock holding norms or try and cut back on holding. Those kind of some administrative measures can be undertaken. I think there's very clearly very limited role monetary policy can play. And I think the RBI has been very consistent in mentioning that in most of the cycles, most certainly now, that the least they can do is make sure the risks don't get generalized and keep a very hawkish disposition. And I think that's what they've been doing for the past 2-3 meetings. So I think this essentially again boils down to weather-related, supply-driven related instances which are driving up these prices. So something that the government will look at very closely. And we're also heading into an election year, so I would think the importance will be much more. And just to add at the very end, I think one of the possible, again, measures is that the free food program that has been introduced could be extended for a few more months.
All right. Lots of aspects that you've outlined. Indranil, coming back to you, what are your thoughts on this? Especially sowing, for instance, for pulses has been a tad bit below last year's levels. That combined with elevated inflation figures consistently. What's your take?
Well, I think sowing was definitely one portion of it. But going forward, I think the reservoir levels also are relatively poorer than the last year's levels due to truant rainfalls on an overall basis, and also the spatial distribution not having been good. And pulses is also a very significant rabi crop, which necessarily means that if the production of pulses, even at the rabi level, is hampered, then we can sustain with relatively higher prices of pulses for some time, and that could be a bit of a worry for the government. So that's one part. I think the other sort of factor that needs to be watched out for, as Radhika mentioned rightly, the government has been quite front-footed in terms of containing price shocks domestically that flows out of the El Nino and the higher rice prices globally. We have contained the exports of rice, and to that extent, the price rise in cereals is possibly contained at the levels where they are. So on one side, you have a positive aspect. On the other side, you have a negative aspect. Going forward, of course, the critical focus of the Reserve Bank of India will continue to be on how efficiently and how well they can anchor inflation at the 4% central line. The last readings on the expectations survey of the households didn't provide any upside surprise, even after the significant rise in the vegetable prices in July specifically. So that's also a positive going forward, along with the fact, as I have been mentioning, the core also has been relatively depressed onto the lower side.
Sure. Indranil, I do want to ask you, like, alongside cereals and pulses, we do have a bunch of other food components that seem to have seen higher figures compared to the previous month. Eggs, for instance, a little bit of a sharper rise in meat and fish as well, spices too. So is it safe to say at this stage that even going forward, risks to the inflation outlook continue to be from food?
Yes, it is broadly. But having said that, I think the vegetables and the pulses are possibly bigger weightages that really affect. Yes, there is some concern also in terms of the protein-rich commodities, but I think the protein-rich commodities also to a certain extent are cyclical, and you might not see a flare-up and a worry per se. And I think what Radhika also mentioned very clearly is that pulses seems to have a relatively longer duration through which it can filter into the inflation cycle. And that's something that we need to continue to watch out for. But as of now, given this 5.02% number, I think the risks of any upside surprise to our forecast and also to the RBI's forecast seems quite limited.
All right. Radhika, what's your expectation going forward? What's next month's figure looking like to you?
So, of course, it's quite early on in the month.
Sure.
But I would think that, our reading of below 5% looks quite possible. And in fact, I think this trajectory does help. So our full year forecast, for instance, is about 5.5%. I think if you were to look, take factor in this number and the likelihood that it would be sub 5% for the rest of the fiscal year, or at least majority of the rest of the fiscal year, I think we could be comfortably about 5.2, 5.3%. So a bit below where the RBI is looking at, and certainly below where we are looking at this point. Again, takeaways policy-wise for the RBI, I think they've been very categorical in mentioning that anything above 4% is still higher than target for them. So I don't think, even though you will see 4.5%, 5% kind of readings for the next few months, that will be reason enough for them to consider easing prematurely. So this would, broadly follow what they expect, but I don't think it's reason enough to pivot towards easing as yet.
Absolutely. Higher for longer, Indranil, is that your thought process as well?
Definitely, yes. And I think given the bond inclusion that we are seeing and the low interest differential, I think the other point that needs to be factored in, we have always been saying that the domestic perspectives have been more important than the global perspectives. But here, possibly, we have a case in point whereby the RBI may be sort of handcuffed and not be able to move unless actually Fed moves. So yes, Radhika's point is justified that we still do not see a very comfortable 4% and a sustaining 4% to be for sure, because of all the uncertainties that we have in the global markets, which includes the crude oil. Crude oil may not be directly impacting inflation, but definitely it has its implications for the balance of payments and the fiscal. Which will be definitely negative for the currency markets, and that in itself can filter into inflation cycles going forward. But broadly, the other point that I very strongly make today is that the RBI will possibly not be moving before the Fed moves. And given the resilience of the Fed, and given the fact that most of the Fed speakers have been more in lines of keeping restrictive for longer period of time, I don't expect the Fed to move before the first quarter of the next calendar year at the best. That's the best estimate that we can take, which means that the RBI can actually move only in the Q2 of FY25.
Sure. So, Radhika, I do want to ask a little bit more about crude oil prices as well. Just when we had seen a little bit of easing in prices right before policy this time around, there's once again a flare up in geopolitical tensions. The trajectory going forward for crude oil still remains a little bit dicey. And while it's very much an evolving scenario, at this stage, is it safe to say that we don't have reason to be concerned just as yet? Also, when is that likely to change? When is it that we're actually going to have to start worrying about elevated crude oil prices?
Thanks. So I think this is, we had already seen, crude prices inch up. The latest geopolitical risk. I mean, our own in-house oil analyst take is that, the two parties concerned at the present conflict are not that big, either on the demand or on the supply end of the oil market. So to that extent, unilaterally, it will not be a big impact. But the bigger is obvious that, this escalation broadens out regionally and involves much more oil-rich countries. But at this point, I would think, if you take a fiscal year to date average is about $81, $82. Our base case is at about 85. The oil prices, even intraday, even within a week, it's been quite choppy. But certainly at current levels, I think it's still quite manageable. But I think where we should begin to pay more attention or would turn a bit more risky is if it approaches 100 and then goes beyond that, which will then elevate the year-to-date average and certainly be a bigger impact on macro variables. I think on inflation, the impact can be contained, merely by keeping fuel prices, the pump prices unchanged, and which contains also that second order effects that you would usually see into transportation and so on. And if you see the non-pump prices, their weightage is quite small, and even if there is a 10% rise there, you would just see, I think, about less than 0.05% increase on inflation. But as Indranil, I think, pointed out a very important point, which is that inflation is one aspect. The global uncertainty is another very big, factor that's playing into the central bank's dashboard. So because weaker oil impacts everything else. It impacts our fiscal balance. It also impacts current account, as well as by extension, the balance of payments as well, which means currency, which is usually the mode of pass-through of these risks, will very much be in importance. So how the currency fares, how much are the rate differentials, these two will matter a lot for the central bank. So I would think that would be the other big aspect which will play on their hand and convince them to keep on hold rather than to prematurely change either stance or to change their rate trajectory.
Sure. Indranil, I do want to, speak about the industrial output figures as well. Very solid figures. Do you think a lot of that's on the back of the incoming, or rather the ongoing festive season? And can we expect these figures to persist going ahead?
So one, I think the festive season may not have been factored into this data, because this data is for August. And there's 1 month's more data that we need to look at. In my opinion, this has been more due to the base effect from the last year. But having said that, very honestly, I've not really gone through the IIP numbers very carefully. But to a certain extent, we see a bounce in terms of even the capital goods numbers, which may be a direct outcome of the government spending that had been quite solid in the first quarter of the financial year and in the other 2 months of the financial year. So first 5 months, to say the government's expenditure has been quite robust, and that's getting factored into the capital goods momentum.
Sure. Radhika, what are your thoughts on today's figures? Very solid figures across industries and across classifications. Also, I do want to ask you, what's your reading of the state of the economy at large? Most high-frequency indicators, including those that we saw today, seem to have come in fairly strong.
Certainly, I think industrial production, the consensus was about 9.5%, so it's even exceeded that at about 10% plus. If you look at the breakdown, and I think that has been consistent in the last few months, is that manufacturing sector has generally done okay. If you take a three-month moving average, for example, it's been holding up. We have also seen an upward revision in the previous month's numbers. So July and August, even June, July, August for that matter, have held up well. Certainly the magnitude of increases is impacted by the base effect, because at the same time last year we had seen quite a soft number. But I think manufacturing-wise, if you look at the PMI numbers, that's also telling you that the trend is quite positive. And you just mentioned the state of the economy. I think this number, while I don't think one really relies on the IIP too much to draw a lot of conclusions, because it's a very volatile number. Sometimes even capital goods tend to be quite lumpy. But I think this adds to the broader trend that incoming numbers are looking good. One aspect that we would also draw upon, so manufacturing looking okay, and I think capacity utilization is picking up. We have also seen PMIs, for example, look quite strong, still in expansionary territory. But I think if you go down to the consumer durables part, especially the non-durables, that's kind of telling you that the informal sector, as well as the retail, the rural sector, for example, there the demand is still, pretty not as, I would think, subdued compared to durables, which usually we use it as a proxy for urban areas. So I think that is flat on the year. if you factor in the base effects. So that is something where we have not seen a very strong pickup as yet. But from the production side, I think certainly very encouraging numbers. And I think to add to that mix, we saw even very good tax collections. First few months, not that strong, but thereafter we have seen very strong direct tax collections, indirect as well, especially GST. So that overall, I think adds to the optimism that in the economic activity front, things are looking quite good. So that should help the next quarter's numbers when they're released.
All right. So all in all, activity in the Indian economy seems to be fairly resilient at this stage. Inflation has finally once again showed signs of easing. We'll sign off at this. Thank you so much for joining us, Radhika and Indranil. Stay tuned to BQ Prime for continuing updates on the economy.